Today, we're going to attempt to describe why Babylon stock has been dropping like a rock. Now, there's probably a much bigger question to ask there, which is why has the stock been dropping like a rock when revenues are going through the roof? And if you take any valuation ratio based on market cap versus revenue, such as our simple valuation ratio, you'll see that this stock appears to be trading at bargain basement prices. Now, it's funny, this statement here about the speculators' deadly enemies being ignorance, greed, fear, and hope. This was taken from Reminiscences of a Stock Operator, which is a phenomenal read written back in the 1920s, I believe, and a lot of the principles hold true today, particularly around human emotion and speculating versus investing. So when you look up any stock in Google, say just about any stock, you can say, why is stock X, and then press the space bar and Google will do the autocomplete. And here you can see the words dropping, falling, collapse. Is it safe? These are all surrounding fears that investors have. And it's no surprise that those who get into a stock without doing sufficient due diligence, just by taking a quick look at the story, will be afraid when they see a stock falling significantly over time. And indeed, Babylon stock has. So you can see here on the left-hand side, that would be the plateau prior to the SPAC happening. And then as of the latest trading session, I believe they're trading around $1 a share. That's somewhere in the range of a 90% loss. And there's a concern there around shares trading below $1, which can trigger a delisting. So when we look at where the revenue growth is coming from, this is quite interesting. So immediately we see some risks. First of all, they have this customer concentration risk. So you can see that last quarter, over 75% of revenues came from two customers, when in the same quarter last year, they only accounted for 17% of revenues. We can also see here that customer 4, the revenue drop there is attributed to, look, it maps directly below to Canada. So we know that that's the effect of the firm selling their ventures in Canada. And you can also see in that same table the increase in US revenues where they're expanding rapidly. Now, we've written about the bull case already. We've written about Babylon several times in the past, and I'll put a link to both those articles in the description of this video. And they talk about the bull case, the company's vision of decreasing healthcare costs using technology such as AI, chatbots, big data, things like that. Now, when we dug into this firm to try and figure out what was going on, we came across an interesting metric that we don't see very often. And it's listed here. You can see in the top table there, you have value-based care. So that's predominantly what they're providing. And we'll talk a little bit about that. And then you have this claims expense, which is greater than value-based care. Well, we immediately dug into that because it's not something that you typically see in financials. So what they describe that as, they say claims expense includes the costs of healthcare services rendered by third parties on behalf of patients, which Babylon is contractually obligated to pay. Well, there's an interesting statement. And then it says, which includes medical, or say estimates for medical expenses incurred but not yet paid using actuarial processes. This is starting to sound like an insurance company where they take in a fixed amount of money, premiums, and then use that to pay claims down the road. The problem is that this is not supposed to be an insurance company. This is what we thought was a telehealth company, but it's starting to appear a lot differently. Now, when you look at last year, the table below there, you can see value-based care was a quite a large number relative to claims expense, which is around the same. So if your revenues are always equaling your claims, that's a problem. How are you ever going to generate a profit? And of course, that's where the company talks about where they're going to use AI and technology to offer healthcare, say primary healthcare services to the patients that they have on their platform, less than third parties. Now, one way to monitor the progress of that is by looking at the actual money being paid for claims. So since they're using actuaries and it's a forward-looking number, we need to look at this claims payable table, which is located in their financials. It shows what claims they're actually paying. So we know that they listed last quarter a claims expense of $247.5 million. Well, the actual claims paid were $233 million. So if we take that 233, divide that out by the revenues that came in, that's a margin of about 6%. That's very low. And because there's uncertainty here, they have actuaries trying to estimate what their claims will be. There's uncertainty as to what direction that could go. This is not looking overly promising, especially when you consider how SaaS firms, high margin SaaS firms operate. This is not what we were expecting. So they say in the fine print that they expect increased engagement of their value-based care members to enhance contract profitability by reducing actual medical costs. So they're going to offer lower cost Babylon healthcare services that will replace the higher cost non-Babylon healthcare services over time. That costs money. And here they say increasing engagement with members under these value-based care contracts requires a substantial investment of time. In other words, it's not going to happen overnight. And we cannot assure that members will sign up to use our digital tools or services. That's a problem because then it's the member that actually has to make the decision to use Babylon's offering, and they may not choose to do that. And there's been a fair amount of debate about whether or not the AI-powered platform that Babylon has built does its job sufficiently, or rather, has there been enough time to assess whether or not the platform behaves as they're advertising on the tin? Now, this was taken from their SPAC deck. This is the basic business model. So they have, let's say, contract lives, 10,000 lives, paying $150 per month. That gives them monthly contract revenue of $1.5 million, monthly recurring, right? That's what's coming in. Then they take that revenue and they subtract primary health costs and secondary health costs, and that's their profits. Now, as we saw earlier, if you take those two numbers and subtract them and there's very little left over, that's not a very profitable business. Well, they are talking about how they expect these 30% margins because they're going to implement all this primary healthcare offering and use this technology and whatnot. And it's just not overly compelling when you consider that we're in a bear market and they're expanding extremely quickly in a very complicated healthcare system. So we look at the basic business model. It's estimate the costs of providing medical services to a population of people using actuaries in a similar manner to how insurance companies price their policies. Then, once you have the responsibility of paying the medical services for that population, you attempt to use technologies like AI and telehealth to provide a cheaper cost of healthcare and hope your customers choose your healthcare options other than others they may be using. And you better pray that whatever numbers those third-party actuaries have been coming up with exceed what the actual costs end up being. Otherwise, you're operating a money-losing business, and nobody likes to do that. So the basic model seems very risky. And then when you throw in some other factors to consider, one is that U.S. healthcare, arguably the most bureaucratic in the world. So 1/3 of costs in the U.S. healthcare system go to bureaucracy. This is a foreign firm with no U.S. experience. So they spent some time, in the national healthcare system in the UK. They've had some experiences over there, which were met with mixed reviews. So some heavily criticized their AI applications, and there's even accusations about them being the next Theranos. Of course, any success story is always met with a lot of criticism, but it's worth looking into. And in the research piece we wrote that accompanies this video, we link to some of these criticisms, and I'll put a link to our research piece in the description of this video. So you have a foreign firm here with no U.S. experience entering the market, and they've been active here less than 2 years, and they expect $1 billion in revenues by the end of this year. That's scaling pretty fast when you consider the customer concentration risk there. That's also a concern. Now, as we said earlier, this firm raises a lot of eyebrows because Babylon has a market cap of $418 million, and their annualized revenues right now are over $1 billion. Annualized is simply last quarter times 4. Gives them a simple valuation ratio of less than 1. It's about 0.4. That's very, very low. And you can see the assets in this table here. We took that from our tech stock catalog. We like to just use this to do relative comparisons. You can see that the price of Babylon Health, at least based on this ratio, is very, very low. Well, there's this notion of the efficient market hypothesis in finance, which says that information is priced in. And if there's arbitrage to be had, that is, the value of this company is greater than what it's trading at, then investors will step in and pick up shares. And presumably, there are a lot of retail investors doing that. Now, what you also need to consider when you look at how low their price, the price of their shares has sunk, is that there's a potential delisting that can take place. So they trade on the New York Stock Exchange. I believe that the rule there is if it trades for less than $1 for 30 days in a row, then the exchange will initiate the delisting process. If that happens, that's going to put further pressure on their price of their shares, and it's certainly not going to be useful when they need to raise capital. So they have about $270 million in their books. It's not very much. As of March 31st this year, they anticipate that will last until the end of the year, and then they're going to need to raise more money. And there's two options there. They can sell equity at possibly very depressed prices, especially if there's a delisting that takes place, or they can take on debt. And in this market, bear market that we're in, it's going to be very difficult for them to raise capital. And I'm sure that investors looking at this firm are taking that into account. So when it comes to investing in Babylon, we wouldn't invest at any price. And that's because there's just too much complexity, and with that comes a lot of risk. There's a lot of uncertainty. This business should have never taken on the responsibility for a population's healthcare costs. Presumably, they could have crafted some sort of business model that had elements of software as a service, and it might have worked a lot better where they didn't have to take on that risk. They talk about these stop losses being in place to prevent them from having to incur too many medical costs, but who knows what those look like, what they involve, or where the stop loss sits. We just don't know. So if you're an investor in Babylon or you're thinking about climbing on board, probably the most important metric here to watch would be claims expense. As we said, if you go into the table in their financials and you look at claims paid, that's very important, and then compare that to revenues, and that should be very useful in seeing if they're able to push claims down over time using technology and building out their own healthcare offering, which will no doubt incur lots of expenses. So please put your comments in the comments section, subscribe to our channel, and thanks so much for taking the time to watch this video today.